Welcome to Insights and Indicators. I'm Jason Thomas, Carlyle's head of global research and investment strategy. In this podcast, I share our observations and opinions on the economic landscape, as well as insights from research being conducted by our team here at Carlyle. Today, I'm delighted to be joined by Shane Clifford, Carlyle's head of global wealth. And we'll discuss some key themes from a recent report we published, The Rise of Private Markets. We tend to explore how shifting market dynamics are forcing a redefinition of portfolio construction and essentially have made the use of alternatives to describe private markets an anachronism. This episode was recorded on August 5th, 2025, and the discussion reflects composite portfolio data and analysis of recent government reports that are accurate as of that date. Before turning to Shane, just a word about what we've seen recently. And I will first discuss recent government reports, and that is the Bureau of Labor Statistics, the July employment report, which of course came out on Friday, August 1st. It contained some of the largest back-month revisions that we've seen, really in decades. And interestingly, there was no explanation as to why the cumulative job growth over the prior 2 months had been revised down by more than 250,000. So it really came as a shock, just because revisions of that size can happen annually. There's an annual benchmark revision where there's an examination of the sample of businesses. There's a re-weighting based on sectoral weights. There's fairly large methodological changes that occur so that the survey better matches actual employment across the economy. But for a month-over-month change like that, it's really quite startling. Of course, the big news was the president's decision to fire the commissioner of the Bureau of Labor Statistics thereafter. What has been interesting from my perspective, based in Washington, is talking to people, career people in the government, and a willingness to actually raise questions about the Bureau of Labor Statistics methodology and changes that, again, have occurred, and real genuine concerns about the reliability of the data. Now, I think that there's a couple of takeaways from the report. First, payroll employment in the second quarter in the United States grew at a 0.7% annualized rate. So that's down from about 1.4% growth in payrolls in the first quarter. So that's some deceleration, but I think this shouldn't be exaggerated. When you look at productivity growth of in excess of 1%, that implies that underlying trend growth in the economy is still at a level close to 2%. So this is hardly an economy falling into recession. It's just that, again, there wasn't as much job growth in the past few months as previously expected. Secondly, the markets, futures, forward interest rate markets really took this to mean that the Fed is going to cut rates in September. That jumped from something like a 40% implied probability to over 80% just in Friday's trading alone. And I think that that is a pretty reasonable expectation. The Fed historically is I would describe it as a dovish institution, as we've talked about previously. A willingness to intervene, to make cuts, really at the first sign of trouble. In this case, the Fed had not, as historically been the case, tried to get ahead of any decline in the official statistics, largely because of concerns that acting too early, trying to preempt any weakness, might actually contribute to price pressures related to tariffs. So in this case, they actually had to see some genuine deterioration, some slowing before they cut. But I think that this should be sufficient for that. However, I do think that it's interesting when you think about where we are in the data today in the United States. Yes, somewhat of a slowdown in hiring, but again, underlying growth that's not so far from potential. At the same time, you do have inflation, core PCE inflation, an annual rate, the Fed's preferred measure, and its 2% target. And the Fed has actually not hit that inflation target now in over 50 months. And so we're coming up on back to school season in the next coming weeks. So to think about what that 50 months means, you have about 3 million people that have been born after the Fed last hit its inflation target who are actually going to be making it to school, elementary school this year, for the first taste of formal education. And not in a single month in any of those children's lives has the Fed hit its inflation target. So, again, I think the September cut is quite likely and quite reasonable. But I think that those that are expecting, a series of cuts, taking base rates down to 3% or so, may be a bit surprised because it feels as though there's an asymmetry in those expectations that, yes, very laser-like focused on some weakening employment, but not, I think, paying sufficient attention to the way that underlying inflation, while much lower than it was a few years ago, still has not yet returned to the Fed target. And I just don't think that can be ignored indefinitely. So with that, Shane, thank you so much for joining me today.
Jason, it's great to be on. And, I think from my seat, I'm kind of where the rubber hits the road. I spend a lot of time globally out in the field meeting with our distribution partners, the private banks globally that we work with, along with the financial advisors, relationship managers, private bankers. They get called different things in different places, right? That work with us, ultimately delivering our investment capabilities to end clients and wealth clients on a global basis. So, I think just listening to your comments there and kind of the world that we live in today, the one thing that I think about is, I think we as an industry, maybe for the last 40 plus years, and I'll use that term industry very broad here, has kind of sold to Joe Public the concept of the 60-40 portfolio, right? And it doesn't matter whether I'm in Japan or if I'm in Tokyo, Abu Dhabi, Paris, Cleveland, Ohio, LA, it doesn't matter. Everyone talks about the 60-40 portfolio like it's this magical thing and that it instantly brings this diversification and, you're good to go. Make sure you do that. And now all of a sudden, when I'm out in the market, people are scratching their heads. There's talk about this 50-30-20 portfolio, private markets. Where do they sit in all of this? You bring up the stickiness of inflation right now, rate volatility. What should one think about as an end investor right now about all of this in the context of 60-40 versus 50-30-20? Curious to get your thoughts.
Yeah, I think that what's so interesting to me, and we just discussed inflation, its stickiness, just again, this remarkable period where it's great that inflation's no longer running at 6 to 9%, but still this sort of inability to bring inflation back down to that 2% target where it stood for so long has really important portfolio implications. Because what we've seen over that 20-year period of globalization, asset-light businesses focused on technology, was inflation essentially disappeared. It no longer became a concern of central bankers, and it no longer was a concern of bond market investors. For so long, bond market investors had to be really sensitized to the potential that they're going to get inflated away, that principal balance that they had in that bond 10 years, 30 years in the future was going to be worth a lot less in real terms. And what you see is that when inflation becomes front of mind for central banks, when inflation becomes front of mind for bond market investors, actually instead of bonds providing a hedge to their equity positions, which is to say bonds predictably rising in value, their yields falling when stock market sells off, you actually have a positive correlation that stocks and bonds now move together up and down. And we saw that, of course, most obviously in April. You had this 12% drawdown in the S&P 500. The last 10 years, last 15 years, you would have expected bond values to surge, to see this flight to safety where yields fall significantly, offsetting those stock market losses. In fact, the opposite occurred. The value of 10-year, 30-year bonds plummeted alongside the decline in stock portfolio values. And I think that really illustrates how fragile, and you could say dangerous, the 60-40 portfolio is today, at least dangerous from the perspective of those who think they're fully diversified by having these buckets. And I think that certainly, I would agree. I'm not surprised to hear the discussions you've had out in the field, because I think just from a theoretical perspective, you're now in a period where this is just not providing the same degree of diversification benefit. There has to be something else that is added to the portfolio to try to provide those offsetting deviations or serve as that ballast that ensures that you maintain some value that, again, whether it's offsetting deviations or, again, just an enduring value in the portfolio while your stocks and bonds actually happen to sell off at the same time.
Jason, as I listen to you there, just kind of the summary headline for someone, I kind of have to think of things in a very basic way. The headline is that 20-year Goldilocks period in terms of where we didn't need to think about inflation is over, and inflation's back. It's back in a sticky-ish kind of way. It may have come down from the highs, but it's certainly not going back to where it had been. And it's back as a factor on the table. Is that kind of the summary that I should take?
Yeah, I find this is really just such a lengthy period of time. And that's why, again, trying to relate.
Yeah.
You had the last time we had inflation at target was over 4 years ago, over 50 months ago. I mean, that is a long time.
Yeah, my hair wasn't that gray actually back then. I'm glad I'm making a visual reference on a podcast, but that's okay.
And again, I think what is interesting about that also is when you go back to the period, particularly after the GFC, when rates were at zero, there was no inflation. The Fed couldn't even hit its inflation target then, but it couldn't hit it because inflation was too low. Inflation was persistently below 2%. So during that period of time, anytime the economy hit a rough patch, anytime there was a drawdown in stock market values, you could really count on the Fed and other central banks to step in with another round of quantitative easing. Of course, those are large-scale bond purchases with the express intent of driving down bond yields, which of course means pushing up their market value. So you really had the Fed as your ally as an investor, because you knew if your stock portfolio would sell off, that the Fed was going to step in and make sure the bond portion of your portfolio was increasing in value. So it really did provide this perfect hedge. And I think it was something that, again, perhaps led some investors into a false sense of security about the degree of diversification that their portfolios possessed. And then now, today, given what we've seen since the Fed started raising interest rates in 2022, if you look at monthly returns in stocks and bonds, it's positively correlated by 60% is the pairwise correlation in those returns on a monthly basis for the last 3 years. So that's the challenge today. And I think that is ultimately the private market's solution, or at least the problem that requires a solution. And it's something, again, I think more and more investors are starting to appreciate it.
I couldn't agree more with you. And when I think about it, I think about the word alternative, right? And a lot of end investors will ask me a lot. They'll go like, well, what's alternative about? Why are you saying alternative? And I think, whether it be hedge funds, private credit, all of these private vehicles historically kind of just got generically bucketed into alternatives. But when I think about where the IPO market is, or I think about just inflows of private capital these days and the shrinking public equity universe, I can't help but think that, is it really alternative anymore? Because when I'm talking to folks out there, they think about credit or they think about equity. I'm not sure they're as obsessed about whether it's private or public. I don't know if you have a view on that or kind of a thought around that. I have a big question mark around that word alternative these days.
I think from my perspective, so much of the attention, whether it's the media or, just broader discussions, is really focused on the supply side. What funds are being raised, capital formation, all of those sorts of issues, what financial sponsors are doing. I think what's much more interesting to me is the demand side. And that is founders, entrepreneurs, management teams. How do they access capital? They need to grow. If a founder wants some liquidity, wants to diversify outside of the business that they founded, where do they go for capital? Well, the answer historically was the public markets. Historically, private markets were really a barbell. It was early stage venture. It was late stage buyout. And those late stage buyouts, those are largely LBOs of public companies that, you'd take it private, you'd maybe fix the company in some way, strategic direction, and then refloat it. And so at that time, a company that would, rise to maybe $1 billion of enterprise value, if it needed additional capital to grow, or again, just liquidity for the founder, it had to pursue a public listing. There wasn't this choice. Today, that barbell's been filled in. Companies can remain private for the entirety of their existence if they want. Certainly up to $35-40 billion of enterprise value are companies that can be very easily absorbed in private markets. And so what we've seen is that, generally, these, again, founders, entrepreneurs, management teams, they prefer to access private rather than public capital. So I think that a lot of times when people see, and then they're focused on the supply side, just more capital coming into private markets, they start to worry that there's going to be more money chasing this finite investment opportunity set. But that's actually not at all what's happening. The investment opportunity set in private markets continues to expand. The demand for private capital over the last 25 years has actually outpaced the growth in the capital formation and the supply of money that's gone into private markets. And you see that, again, with the number of public companies, not just in the US, but globally, falling by about 50%. For the most part, those are yesterday's growth stocks that have gravitated to private portfolios. So if you're not in private markets, you've now lost access to really that core constituency of stocks that provided so much of the returns over the last 40 or 50 years. So again, from my perspective and, understanding the management teams, they're thinking, it's something I just feel is lost in these broader discussions about, what private equity firms are doing, what funds are being raised, how institutions' allocations are moving to private, or, it's this underlying demand that I think is the most salient feature of the growth of the market.
And it certainly sounds to me that, basically you're telling me on the demand side, the barbell is going to come back. And I kind of look at life along a spectrum. You're kind of describing this barbell. It's the same concept here and it's all blurred now. And it's, if anything, the privates have kind of encroached upon what had been the public domain. And you don't see a reversal of that coming, do you?
No. It's quite the opposite. I mean, these trends are accelerating. I think that, in the old days, when you went public, generally the investment banks had this army of researchers that would publish stock research, and that would essentially serve as a marketing tool. That would explain to stock market investors how you made money, explain about the business. And then there was, of course, a settlement after the Spitzer investigations in New York. And they found that some of that research actually had an explicit marketing function, that, there was conflict of interest. And I think that this is interesting because it essentially meant, when you look at the cutback in research coverage, it means for companies today, management teams, when they go public, they're effectively on their own, and they have to invest all of their time and effort to, again, making people aware of how they make money, what their strategy is. They have this constantly churning shareholder base. It's quite challenging. And so as an alternative to that, to have a capital partner through private markets who is aligned economically with you, your success is their success, and also philosophically aligned with you, because that's why the deal was done. You both see some opportunity here that you're seeking to exploit in the market, is a far more attractive proposition. And I would say that it's funny, when we surveyed our CEOs pre-pandemic and asked about becoming a public company CEO, there was actually 40% who suggested that they didn't want to be public company CEOs. And when asked why, they said that it's because about 30% of their time was spent marketing to this constantly churning shareholder base, having to do analyst meetings, all those sorts of things. And they said, what I like so much about private markets is that I know my shareholder, we're aligned, again, economically, philosophically, and I can just focus on operating the business. So, as more and more people have that experience and they contrast it, I do think that there's going to be this selection effect where the best managers are going to opt to be CEOs of private companies. They're going to have, this stable of CEOs that many large fund families have, the best operators that can be deployed in different companies, different situations strategically. And I think that that's just going to further accelerate this process.
This is fascinating. I want to dig in a bit. And what takes up a lot of oxygen in the room these days is private credit, right? And it's just such a big topic. And there's a lot to private credit. You know, that's a big kind of catch-all for a lot of things that fall under that. But if I'm an advisor, if I'm a private banker out there in the world today, I think the one thing that I'm trying to evaluate is, where are the risks and what's driving that demand? Like, what's the macro backdrop there, right? And then what are the risks that should kind of keep me up at night, specific to private credit? What should I be thinking about there, given everything that's going on with the widening of credit spreads and things like that right now?
Yeah, so I think what is most attractive of private credit, why there's been this huge surge in allocations towards private credit, is the extent to which it has displaced banks, the extent to which it's displaced syndicated borrowing. And so it's really become the avenue of choice for deal finance, M&A activity, and that's mostly, the direct lending space. And I think that the attraction is really related right now when you have base rates at, 4.3%, you add, credit spreads of 400, 500, 600 basis points. Well, now you have expected returns that are 9, 10%. Maybe there's some back leverage many of these funds employ. They can get up to 11, 12% annualized returns. And I think many investors say, well, wait a minute, I'm only budgeting 8 to 9% returns on stocks where I sit at the bottom of the capital structure and I have to accept all of this macroeconomic and market risk. Why don't I just take a 10%, even higher expected return in direct lending, private credit, to sit at the top of the capital structure? Now, the risks, to me, it's that right now, because of those base rates that make the private credit so attractive, again, direct lending, it's also something that has slowed M&A activity. And a lot of that is really just, you have assets that were acquired in one interest rate regime that have to be sold into another. So, some compression in valuations that you've seen in that sort of 2020, 2021 period. So in this part of the cycle, over, I'd say the last 12 months or so, there's some concern that there are too many direct lending vehicles in relation to the actual M&A volumes. And until, it could be rates come down, it could be just, again, a willingness to accept some of the market pricing. It could be just a even more robust growth in secondaries. But until the M&A volumes actually rebound, and you could have a 50 or 60% increase very easily, that would be more consistent with M&A volumes relative to GDP based on historic relationships. But until that happens, I think there is going to be more pressure on spreads. And so you get into the question of, well, I was expecting to get 600 basis points over base rates for this risk. Right now, the market's only offering 500. It's a pricing risk that I think people should be conscious of. And that's why my recommendation has been to focus on areas of private credit that are less penetrated. So that is referred to as non-sponsored lending. So you're essentially originating loans that's not part of an M&A transaction or a sponsored transaction. It is just to, perhaps it's a family-owned business or another business that maybe they're expecting to go public in 12 months. They want some liquidity now in advance of that event. Also, of course, investment grade, an area where if you have irregular collateral or if there's some drawdown feature, something that makes it unique so that it can't really go into the public securitization markets, that's also an area where the spreads, the risk-adjusted returns look especially attractive right now. So again, to me, with the direct lending, the risks is mostly related to the specific sponsored-backed M&A dependent space where just because of this temporary lull in M&A volumes, you do see a bit more competition and spread compression than elsewhere.
So I don't have a life. I need a hobby, Jason. So I spend a lot of time at the weekends reading your research reports and others out there in the industry. And one word that pops up a lot more these days than perhaps in the past is volatility. And as I kind of understand bonds, I wonder, are they really still as effective as a hedge as they were in the past? That's something that I'm kind of, in my mind, trying to figure out these days. And I also kind of start to think about, are private assets the more defensive play right now with all this volatility? How should I kind of organize that? Help me with that.
Yeah, when you think about volatility, the volatility of an asset is partly a function of the markets in which those assets trade. Okay, so public markets, of course, volatility is driven by order flow. If you have an order book imbalance, if there are more sellers than there are buyers, the value of your asset is going to fall. And that may have nothing at all to do with fundamentals. It may have nothing to do with the performance of the business, its sensitivity to the macroeconomy, or anything else. It may just be that other investors who have the same position as you have to raise cash and have to get out of that asset, and that generates volatility. Private markets, by contrast, it is less volatile because the transactions generally are change of control transactions that happen over, a period of years. And those sorts of transactions, it's very different market environment. The way I would relate it, it would be like a typical, thinking about private market volatility, it would be like buying a stock because you think the company is a takeover target. So you're buying the stock with the expectation that there's going to be a 40 or 60% jump in value over, say the next 6 to 9 months because of an announced takeover. If that is your thesis, if that's why you bought the stock, you are not at all concerned. In fact, the short-term fluctuations are of no consequence to you at all. It's actually when that transaction occurs and the actual price that is paid for it. So I think that it's important, this uncorrelated nature of private markets. I think it's important to note we're not talking about uncorrelated because you have appraised NAVs on a quarterly basis. It is uncorrelated because that M&A transaction, those, again, the change of control transactions, just operate very differently. And you have these discrete jumps in the value of the company, again, based on fundamentals, based on the earnings growth over the lifetime of the ownership. But again, it's something that you're not at all at risk simply because another shareholder, another group of shareholders that holds your position in common has to liquefy their stake, get out of the business, depressing the value of your asset.
This is fantastic, Jason. I think, from my seat, what really is quite special is the fact that we're now bringing our institutional investment capabilities to the wealth channel in a very thoughtful, constructive, and special way across all of the verticals at Carlyle. And whether it be private credit, private equity, our secondaries and co-investment business, and so on, I feel very fortunate that I get to work with people like you. And my key takeaway from all of this, Jason, is I need to get you out on the road more, because I think you have a great way of helping us all navigate this economic environment and really think about how private markets are now core to what we do in terms of portfolio construction. And I really have enjoyed the time today, and to be continued, as they say.
Well, thanks so much, Shane, and thanks very much for joining us this month. And I would encourage listeners to take a look at the paper, The Rise of Private Markets, on the Carlyle website. I hope you enjoy it and, look forward to hearing from those who have a chance to read it. And as always, thanks for listening. And I hope you'll join us for next month's episode of Insights and Indicators.